Let me walk you through some of the homework in Chapter 9 to get you started and to give you some direction as to how to do these problems. The first one I want to walk you through is exercise 9-16, which looks at depreciation under each of the methods that we're looking at: straight line, units of activity, and the declining balance method. One thing I want you to note when you're reading these problems is to make sure you look at that date. In this problem, they bought this machine on October 1st. So therefore, we need to make sure we revise our depreciation because for that first year, it has not been held for the whole year. Therefore, we can't depreciate it for the whole year. So let's look at this for the straight line method. Our straight line method, remember, our equation is cost minus our salvage value, and we're going to divide that by our useful life. And we're going to get the same amount each year. So for this straight line method, we'll find our cost, which is $150,000. We'll subtract that salvage value, which is $12,000. And we're going to divide by our useful life, which is 5 years. Now, if I look at this and I do that math, I should come to $27,600 per year. Now remember, we have not held this for a whole year. We only bought it in October, so I can only, under the straight line method, depreciate for October, November, and December, or 3 months. So I would take that $27,600 and times it by 3/12, which is going to give me the depreciation for that year of $6,900. That's my straight line method. But now let's look what this looks like under the units of activity method, where they tell you how many it's based on machine usage, which is 1,700 hours. So under that units of activity method, remember the first thing we have to do is find out what is our depreciation per unit. So to find that out, again, I take that depreciable cost, which is cost minus salvage value, and I'm going to divide that by the total units that I expect this machine to produce. And here we're talking about hours. So my cost minus my salvage, and divide that by my total hours. So that's going to tell me that for every hour, I should depreciate $13.80. So now I look to see how much I've actually used during this year. It was 1,700 hours. I multiply that by the $13.80, and I get my depreciation for this year of $23,460 under the units of activity method. Now notice under this method we did not have to adjust because we only held it for 3 months, because that 1,700 hours is telling me how many hours I used it during those 3 months. So that is already compensated for. Now let's look at the last one, the declining balance method. Under the declining balance method, we're going to first find what that book value is, because they want the depreciation for both 2019 and 2020. And remember, I have to find that depreciation rate. To get the depreciation rate, I'm going to take the 100%, and I'm going to divide by my useful life, which is 5, and multiply that by 2. So my depreciation rate is going to be 40%. I take my book value times my depreciation rate to get to that depreciation expense. Now in that first year, my book value is the same as my cost. So I times that by my 40%. But here, that 40% is an annual rate. So again, I have to multiply this by 3 over 12. So in year 1, my depreciation expense should be $15,000. Now, let's look at year 2, or in 2020. I take my book value, which is now $135,000. I get that by taking the 150 minus the 15, cost minus accumulated depreciation, and I'm going to times that by 40%. In year 2, it's a whole year in 2020. So my depreciation for year 2 should be $54,000. So hopefully that gives you an example of each of these depreciation. Okay, let me walk you through now 9-8, which goes through the revised depreciation. I need you to remember that depreciation expense is just an estimate, and sometimes things change, and therefore we have to adjust our depreciation. Under revised depreciation, we're going to take our book value minus our any new salvage value and divide that all by your remaining useful life. And then that will give you your depreciation expense. So let's take a look at these two situations. First of all, the building. You can see it was acquired in 2013, and now we're looking at 2019, so we've already depreciated it for 6 years. I'm going to find my book value by taking cost minus my accumulated depreciation. I'm going to get rid of those zeros just to save some space over here. Therefore, my book value should be $686,000. I'm going to look at what my new salvage value would be, which is $26,000, to give me a total of $660,000. Now I'm going to divide this by my remaining useful life. It's proposed to now be used for 50 years, but I've already used it for 6, so that means I have 44 years left. So I would take my new years minus what I've already used it for. I divide that, and my new depreciation is going to be $15,000. Let's try that again. So let's look at this warehouse. The warehouse tells me that I purchased this in 2014. It's now 2019. Again, I'm going to do this the same way. I'm going to take that cost minus my accumulated depreciation to give me my book value. I'm then going to subtract my new salvage value to get $75,000. I have to divide this by my remaining useful life. I have 20 years that is now going to be used for, but I've already used it for 5. So that means I have 15 years left. I'm going to divide that, and my new depreciation expense should be $5,000. Now here, it just wants you to record that total depreciation expense for the building, only for the building. And again, just as a reminder, I would debit depreciation expense, credit that accumulated depreciation. Here we're going to signify that it's for the building and include that $15,000. Now let's look at this last one. Okay, this last problem is looking at the disposal of our assets and what do those journal entries look like. So let me walk you through a couple of these dates here and show you how to dispose of an asset. So the first one that's noted on January 1st, it says we retired a piece of equipment and we used that equipment completely. It was for 10 years. We've now used it the 10 years. We've already depreciated everything. All we have to do is get that equipment off the books. So to remove our equipment off the books, there are two accounts that are tied to that equipment, the accumulated depreciation and the equipment. So we need to debit that accumulated depreciation. And remember to always signify which accumulated depreciation we're talking about. Here it's the equipment. So we would debit that amount for $62,000. And then we're going to have to credit our equipment amount for that same $62,000. And we're done. Now on June 30th, it tells us that we sold a computer. It was purchased on January 1st. Computer cost $45,000, had a useful life of 5 years, and no salvage value. And we got $14,000 cash for this. The first thing we have to do, again, is to figure out how much depreciation do we need to record to cover this portion of the year. So you can see they're using straight line depreciation here, no salvage value. So that means the cost of the asset divided by the useful life is $9,000. They've recorded that each year for 3 years already. Now at June 30th, we need to record half of that year. So I multiply that by half and I get $45,000. So before you can dispose of any asset, you have to make sure that depreciation is up to date. So I will debit my depreciation expense and credit accumulated depreciation. This again is for the equipment category. And that would be for $4,500 for that half a year. Now that that depreciation is all up to date, I can then dispose of the asset. So first I have to figure out what is my book value. I need to get all of my accumulated depreciation off the books so that I can then account for that. So we held it for 3 full years. So that would be $27,000. I just recorded another $4,500, which then brings me to total accumulated depreciation of $31,500. I need to record that I got cash for this asset. That's the first thing that I would start with. It's easy. So I'm going to debit my cash, and I got $14,000 for this asset. I need to get rid of the accumulated depreciation. So I'll debit that accumulated depreciation for the $31,500. I need to then make sure I get the equipment off the books. The equipment was on the books for $45,000. So I'm going to credit that. And remember, your debits have to equal your credits. So they don't. I need another credit, which is a gain on asset or gain on sale. And that gain is going to be for the difference to make my debits and credits equal, or $500. All right. And finally, let's look at this last one. We discarded a delivery truck. It was purchased on January 1st, 2015. It cost $33,000 and it was depreciated on a 6-year useful life with a $3,000 salvage value. It is now the end of the year. So we need to first, we have to record that depreciation expense that I would be recording on January 1st. But since it's a full year, I know cost, which is $33,000, minus my salvage value, and divide that by my useful life, which was 6, which means I'm going to depreciate $5,000 each year. So before we get rid of an asset, make sure that depreciation is up to date. Debit my depreciation expense. Credit that accumulated depreciation for that $5,000. The second thing then we can do, again this is for equipment, is get the asset off the books. Here we didn't get any cash, we just discarded this asset. So there's no cash to record. So I need to get rid of the accumulated depreciation that I've recorded so far. Which comes to the total of $25,000 because I did hold it for 5 full years. The equipment value I will credit for $33,000, which means I need to record a debit or a loss on sale of $8,000. So hopefully that helps. If you have questions, you let me know.